Life is beautiful. Life is good. Life is good, sir. Cool. Hey, good morning, everybody. I'm just reading Charles' message. Right on a cool at night. Hey, Charles, if it was good, let me know what boat it was. So you went around Victoria Harbor at night in a private junk boat. Cool. The one I want has to be wooden and it has to have sails. I don't want a yacht. Oh, I'm just a really rich guy. Well, yeah. Thank you, Captain Obvious. This beautiful boat belongs to some poor guy. Yeah, that's just funny. They all belong to rich guys. Anyways, that's why it's good to be a rich guy. Cool. Anyways, hey, good morning, everybody. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Today is a Wednesday, Brexit Day, the real Brexit Day. So I think as of right now, Prime Minister May is waving a single finger at the European Union for all to see. So goodbye, Europe. Yeah. So yeah, they delivered Article 50. Huh? So goodbye, Europe. But it's also Wednesday. It's oil inventories day. Great, great, great. Cool, cool, cool. Yeah. So another opportunity to get out of bed and trade, right? By the way, my name is Wayne McDonald. I am the Chief FX Market Strategist for TradersWay.com. Thank you for being a client. We appreciate you. We work hard for you. And we want you to succeed because it's also good for us. We have a symbiotic relationship with you. When you trade, we make money because we're a service provider. So we pride ourselves on excellent service. The spreads are competitive, and our customer service staff is good looking. So anyways, I do these sessions 7:30 in the morning, Monday through Thursday here at forex.today. First Friday of the month, you will find me at FX Street. I'm here to help. You may ask questions. I encourage questions to be asked. So today we will do some technical analysis. Oil inventories occur at 10:30 a.m. New York time. So that often moves oil. That also often moves the Canadian dollar. Nice. How's the coffee? So let's review a few things that we did yesterday. A lot of the topic we had yesterday and even on Monday was to prepare for potential reversals in the market. You guys remember that? So Monday and even Sunday, when I did the swing trading class, one of the things we found is a lot of these markets opened above our entries, right? And so how do you deal with that? If you're bullish and it opens up too bullish, is it good or is it too good to be true? And my advice was your only mission, even as a bull, is to buy it low, to buy it at support, to buy retracements. And if it opens up high, it's just too expensive. It might be going in the proper direction, but it's simply too expensive. And there are reasons for this, right? I think I called it fool's gold. Here's gold opening up high, but if you're a bull, you want it to open low. You want the mispricing of gold. You want a deal, right? So anyways, we called this fool's gold on Monday. And to prepare for a reversal, how about, right, $1,260.46. Check that out, guys. It touched it for a millisecond, immediately dropped. And then the conversation on Tuesday was that you don't sell the initial touch because it's a bet, isn't it? You're betting that M4 is going to hold. Well, we know it could go up to R2. You ever watched Talladega Nights? He's like, Dad, I lived my whole life under the idea if you ain't first, you're last. He's like, hell, son, that doesn't make sense. You could be second, you could be third, hell, you could even be fourth. Well, look, it could be M4, it could be R2. I mean, right? So what you look for, reversal patterns at places you expect the market to reverse, which is different than a gamble. You're not betting M4 is going to hold. Although if you're a scalper, that's exactly what you want to look for on like a 1 minute chart. That you're going to hit the M4 and it's going to drop. Then you take that shot, but it's a scalp. You're only going to get it back into the roll reversal, right? So what is the assumption? Down to the roll reversal and then back up. Well, why would you expect it to go up if you expect it to go down? Why, if you expect it to go down, why would you expect it to go up? Well, it's got to hit support, which is a roll reversal. Let me just draw it. Make sure you guys know what I'm talking about. Okay. And the thing is, you expect it to collapse because there are no more bulls, right? Where are the bulls? They took profit right there, right? Right there. That was the target. We know it's the target. See, you think in certainty now, or at least I'm hoping you're starting to think with certainty. You know where the bulls are going to take profit. This isn't a sell zone, the red area up here. I call it a pivot profit zone. So if it's a pivot profit zone, what is the assumption? The assumption is there are bulls that will get out of the market. Retraces and it bounces, but very few of the bulls buy it back. So what do the bears do? That's when the bears get involved, right? So anyway, so we drew this we drew this pattern here in a discussion yesterday about looking for potential reversals, which would be either double tops and drops or lower highs and drops. I mean, and you could treat this as a double top. I mean, it doesn't change anything for me. It's about the same, even though it didn't hit the M4. Or you could treat it like this. Okay, that's fine too. Whatever floats your boat, right? Okay, but the thing is, here on Sunday and Monday, we're anticipating this pattern to happen. And by George, it happened. Okay. Now, is it going to reverse or is it going to do what it did last week? Well, we don't know, but the certain thing is we know we can't buy it here, right? Same thing, you can't buy it up here. You'd be a fool. That's why it's fool's gold. I mean, is that resistance or is it not resistance? Do you respect this area here with this area and then overlap that with the weekly, top. You either do or you don't, right? So maybe it comes back down to this pivot cluster. The Stokes, however, on the 4 hour says up, up, up. Okay, that's what this says. So, well, deal with it. Of course, you may get a fakie like this. The reason you would is that price action would supersede the oscillator. Why? Why would that be the case? Why would price action supersede an oscillator? But an oscillator is a lagger. Yeah, price action is. Yes, Fred's also right. Oscillators are directed to price. That's true. I mean, that's all they're doing. But price action is a form of leading indicator. So the oscillator is measuring what has happened. It's measuring the candles relative to the previous candles. Okay, so when it's falling, it's saying this candle is lower than these few candles. This candle's lower than these few candles. This candle, didn't make a low relative to this one, but is lower than that one. And then this candle did not make a lower than this one, nor did it make a low of this one. It's oversold. And this one, its low is above that low and above that low, because my settings are just looking back for the last few candles. So it's saying, well, we're actually starting to move up. That's all it's telling me. But what's the leading part? Well, you, as a bear, if you are a bear, you would expect the lower high into the roll reversal, into the weekly R1, into the monthly M3, and then back down to here. Because your whole trade plan in looking for the reversal pattern, okay, is to take it from 1260 back into 1240 to 1236 area. Okay, that was your plan. Well, if you had a plan, right? And notice that that would be lower than this, which means next week you get probably a 3-wave correction and then move back down the other way. Beautiful sunrise this morning, just beautiful. How many people watch the sunrise and think of Gordon Gekko calling them on a giant cell phone? God, bud, I wish you could see this. I just made $1 million in Hong Kong. I want you to play with it. By the way, I'm gonna go ride my dune buggy with some hot girl. Don't you wish you were me? Yes, I do. I wish I was you. Money never sleeps, pal. Yeah, totally. Oh man, I gotta watch it. I gotta watch it today. Like right now, man. I gotta watch it. Yeah, that's funny. That's perfect, John. As soon as you typed it, I could hear it too. Yeah, that's a whole different scene, Kareem. That's a whole different scene. But honestly, though, that scene, he's like, wait, he's living in the Cape, or no, that Cape's more up Boston. Where do the New Yorkers go? The Hamptons, right? He's up the beach house in the Hamptons, dune buggies on the sand. You're like, oh man. Yet, so Michael, you're out in Michigan. The interesting thing about Michigan sunrises is that they're often the deepest red color you've ever seen. Because I assume it'd be very, I'm assuming you're not talking about Detroit. Detroit never has a sunrise, right? The sun sets, but it never rises. But, you know, having grown up in Canada, I can tell you the sun sets in the summer in Canada, specifically northern Saskatchewan. It's so red. It's redder than red. It's a red brownish. I mean, it's blood, right? It's blood red, and the reason for it is there's forest fires always in the summer, way up north, and just it gets into the atmosphere, and you just get these sunsets that are just unreal. Yeah, and of course, Africa has you know, everyone's seen in the movies, right, where you just have this ginormous sun that's setting. You can see like animals running in silhouette across the sun. Cool. Yeah, I miss South Africa. It's been like a year since I've had Impala. A person shouldn't go a year without Impala, I'm telling you. So, ba, 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 ba. All right, so anyways, maybe you take this down. Well, that would be a trade plan, right? Wouldn't that be a trade plan? What does this tell you? What do you see here? I think gold is heading back down to 1200 and below. Okay. Right? Down here, right? Wouldn't you follow the oscillator back down to the support? Okay. So what does this tell you? This is heading down, but probably not today. Or if it does today, then tomorrow will be back up. So you ready for this? It says to me, let's say today I'm right and it does fall. So let's just assume, because it adds complexity and it makes it more interesting for me. All right. So, anyways, let's say this does happen. Okay. Then we're going to get a little, right? So down today, but its destiny must be fulfilled. Fred, you're blowing out my ears when you yell at me like that, Fred. Yeah, we'll get to oil. Got it. Oh, Fred! Stop yelling, Fred! It reminds me of the Knights of St. Denis. He said it! He said it again! Anyways, so its destiny must be fulfilled. This oscillator, oh, it will rise. Ooh, it will rise. But what does the daily say? Yeah, oh, it must fall. And it will. It will fall because it must. So, therefore, let's bring this sucker all the way up here again. So let's say down today, up Thursday, and then what? Hoo-ha! 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 We bring this down. Friday, Monday, Tuesday, Wednesday of next week. So a drop into the pivot zone to fulfill that destiny, a complete 100% rise back to where we are, which would be the double top for the long-term traders. Remember, the short-term traders were on Monday, on Sunday and Monday, I was discussing the double top. And for us, you know, peons, they only look at like 4-hour, 1-hour charts and below, right? This is our double top. Well, for the bigger boys, Friday is going to be the double top. And this whole thing's going to drop to fulfill that destiny. That is one plausibility. That is plausible. Okay? Doesn't mean it will, but we're going to have new pivots on Sunday. We're going to have new weeklies and new monthlies. And I think you'll be amazed that, you know, somehow it'll all make sense after the weekend is over. I think the new pivots are going to come out and will totally make sense. Okay. Right? And for gold, the pivots are not going to move much. The monthly pivots are just almost going to do nothing. Right? Right? Let's do the calculation. Oh, right? Open, low, high, and we close, let's say, here on Friday. Back at the weeklies, right? Oh, Mikhailovich wants to know the formula for pivots. Can't find it anywhere. Oh, okay. I plus low plus close divided by what equals central pivot point. Yeah, oh no, algebra again, right? For AX plus, oh wait, AX squared plus BX plus C equal to X, no, equal to 0 when X is equal to B, let's see if I remember, B squared plus or minus the square root. That's not right, is it? Plus or minus. Oh, that's not right. That's B. I don't think it's B squared. I think this is it, isn't it? Yeah, this is plus B squared minus 4AC all over 2A. Let me correct myself. Is that right? Can anybody grade that? Did you miss all this stuff? Anybody correct? That's correct, isn't it? When ax squared plus bx plus c is equal to 0, then x is equal to b plus or minus the square root of b cubed minus 4 times a times c all over 2a. Yeah, it usually has two solutions. That's why you have the plus or minus. Yeah, Fred? No, I didn't get it, Fred. No. Well, maybe I'll squeeze enough half points to get a B minus. Yeah, but anyways, yeah, this other one here, okay, this is something you can handle. High plus low plus close divided by 3 is equal to central pivot. Yes, you are, Fred. You guys are so... You all right? Do you want another one? You guys tell me if you know this one. The expected return of a stock is equal to the risk-free, and these are all subs, right? The risk-free rate of return plus the beta of the market times the expected return, expected return for the market now, because it's by the beta, minus the risk-free rate of return. You guys know that one? Right? That's right. Yeah, what's beta? Beta is, you can consider it the volatility of the overall market. So let's say you have, let's say, Apple computers, and you're trying to figure out the expected return by investing into Apple computers. But what about how much do those types of stocks move? So let's say you put them in a category of high-tech, large-cap stocks. Well, how much do those typically move up and down in price? That would be the beta of that sector. Okay? Does that make sense? Yeah, cool. So the expected return for investing into the stock is the risk-free rate of return plus the beta times the expected return for the overall market minus the risk-free rate of return. Risk-free rate of return might be like a 10-year T-note, for example, or a 2-year note, 5-year note, that kind of thing. Or if you just put money in the bank, that's your risk-free rate of return, right? So how much money should you make or expect to make, right? How much money should you expect for your investment when you could just have no risk? Because remember, you're taking on risk, right? So if you have a risk-free investment opportunity, like buying government treasuries that will pay you 2.5%, you're like, well, let's say you have $1 billion. You're like, well, I could just buy some treasuries and earn 2.5% and know that it's risk-free. I will get my money back, right? That's a risk-free rate of return. But then you have this other opportunity, and they're like, hey, man, you can make 5%. I'm like, 5%? Well, first of all, I have a risk-free opportunity here of 2.5%. So whatever you're telling me 5, so really my upside here is only 2.5. Well, what's the risk? Oh, well, you could possibly lose all your money. What? For another 2.5%? Forget it. I'll just do the risk-free rate, right? So you might have your own break-even expectations, let's say, before you take that leap and take on more risk. And this is the CAPM. This is the capital asset pricing model. So if you're in finance, this is easy, basic stuff. Right? So as an analyst now, you're like, is this, maybe you work for me, and I'm like, hey, let me know, is this worth the risk for me? And you're like, well, let me run it through the CAPM. You're like, well, you're really not going to make that much money for a fair amount of risk. So there's too much risk, not enough upside. Okay. Yeah. Hey, Dad. Yeah. Yeah. This is more finance than it is economics. The other one I showed you, that was economics. Now, here's the interesting thing. I'm doing game theory now, and it's getting really complicated. Because we're doing like mixed strategy stuff, and originally when we started, you'd look at a situation or a scenario that would only occur once, like in war, for example. And you're like, well, there's going to be one battle, you kill or be killed, right? But if you expect to play the game over and over and over and over and over and over again, things start to change. And cooperation starts to develop because you're going to run into these guys again. And maybe you're better off not killing them. And they realize you're not shooting to kill, so they decide not to kill you because everyone wants to live. Yes, killing everyone's the point of war, but you also don't want to die. So if you play the game enough, all of a sudden nobody ends up killing anybody because nobody actually wants to die, which is interesting. So it starts changing. So you start weighting your strategies, and it changes over the course of time that you're playing. Right? And I'm thinking, wow, this is like a discounted cash flow. And I turn the page, and they're like, yeah, so now you have to start discounting into the future, going back, just like you do in finance. You're like, oh my God, I just thought of that. I'm like, I remember reading, thinking, oh my God, I totally see something happening here. Maybe I can win like a Nobel Prize. I switched the page, and I'm like, damn it, someone else thought about this. But yeah, so you start discounting into the future, because in finance, money 10 years from now is not as valuable as money today in your hand. All right, so anyways, apparently this can happen with strategies and weighting of different future strategies based on past strategies. And wow, it's getting really complicated, but it's interesting. All right, so let's get off gold. Yeah, well, that's good for me because, yeah, whatever. Let's take a look at the beast. We spent a lot of time with the beast talking about ranges and lack of trend. How did we do? Just as we've been going along, I've been practicing with you to find support and resistance, knowing that we don't have a strong trend developing at the moment. So we're range bound. Well, eventually ranges break, right? But notice, if you recall, we identified up here 5 or 6 different levels of resistance. And look, it was tested 1, 2, 3, 4, 5 times. Right? Notice how it dropped into little mini supports, eventually finding the bigger support, and then dropped to the next level. And what did it do? The old support was now resistance. And we just dropped to the new level of support and resistance, back to support, back to resistance. It's a very interesting phenomenon, isn't it? You see how it's just occurred over and over and over again? And maybe it's developing into a trend. Okay. It's interesting, isn't it? So I can't wait to see what happens with new pivots. So here's the first day of the month, and we're at monthly central pivot. We have resistance, 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 as we've marked here. As a bear now, and you could be a bear because remember how we were expecting yen strength in the month of March? So you totally could. And the target then for a bear is supposed to be way down here, when just above 136, 136.26. We're not down there, are we? So we're caught right now going into what, the last couple of days of the month, and we're just basically at monthly support 1. Very slow, huh? Very slow. But is there a takeaway from this as far as this type of price action? Things like if you sell it and just leave your stop above the resistance, you might have been in this 3 weeks. 3 weeks. Okay. Not ideal, because you don't really want to be short pound yen for 3 weeks. But could you possibly do it the other way around if we were slowly working our way up? You guys don't realize it now, and it's amazing because I've been talking about this for so many years now, I'm almost forgetting. But the way that we trade forex is different in the last, I guess it's going on 10 years now, is different now. We're not truly trading forex properly. And by us, I even mean the banks. I mean hedge funds. We're not doing it right. We're doing this all the wrong way. What, buying and selling for profit. So if you go back over the last 50 years, the way that foreign exchange traders work was vastly different from what we do day to day today. And so one of the role models that I use for myself in thinking about the history of this industry is the very first hedge fund focused on foreign exchange called FX Concepts, started by a man named John Taylor. I think it's a different John Taylor from the Taylor rule, but I keep meaning to look that up. But anyways, there was a guy named John Taylor, started FX Concepts, I think in the late 60s, early 70s, maybe? I don't know. But hedge funds were new, and this was a foreign exchange hedge fund, which is totally weird, right? And I remember when I, relatively new into my career as a currency trader, I ran across this guy, and the article was talking about, based on IRS filings, this guy was paying himself like $150 million a year, but for like 30 years. I'm like, what? Because I wanted to know, who's the top dog in my industry? You have to know what you're aiming for, right? I mean, like, all right, so who's the biggest, baddest forex trader, right? I just need to know, right? So I found him. He's been doing it for 30 years. Great. How much does he make? Boom, 150 million every year. That's the stuff he, claims at the IRS. I mean, after all those deductions. I mean, 150 million? I'm like, what? That's some pretty good money, right? And here's the thing. They basically didn't make any pips. Just your head explodes when you put that in. Now, obviously, his firm got bigger and bigger, and pretty soon he was, you know, managing money for, you know, pension funds for states and, you know, big institutional investors, right? But they were not even trying to make pips. Well, hedge funds today and other speculators like you and me, we're in it for the pips, right? But historically, pips had really nothing to do with it. It was all earning interest. So when I was trading currency, my first few years, for example, one of the trades we did a lot, pound yen was huge, but Kiwi yen was one of the special ones, right? And you were earning 8.75% on a Kiwi long position, and you were paying Japan 0.5. So let's just simplify it. Once you borrow money from Japan and then you stick it in a bank account in New Zealand in Kiwi dollars, right? You earned at least 8%. 8%. But if you were leveraged 100 to 1, that meant you had let's say $1,000. You could leverage it to $100,000. Go to Japan, buy $100,000 worth of yen, or borrow $100,000 worth of yen is really what's happening, right? 100,000 US dollars of Japanese yen. But remember, you only ponied up 1,000, but now you have 100,000 US dollars worth of Japanese yen, and then you convert your $100,000 worth of Japanese yen into $100,000 worth of Kiwi dollars, right? So you just borrow it in yen, convert it into Kiwi. You earn the interest on the Kiwi investment, but you have to pay for your loan from Japan. You understand? And then whatever's left over, you collect. But you've only ponied up $1,000. So when it's all said and done, you're earning 800% per year in interest. Only interest. Only interest. You invest 1,000 of your cash in your forex account, and if you can hang on to the trade for a year, even if you earn no pips, you collect $8,000 in interest. What? Like, wow! That's sick, right? $8,000 in interest. Yeah. When will those days be back? Well, they will be back, right? Just the world will normalize. You wait. You know, I've been doing this long enough where I did it, and then it all went away, and we went to ZIRP, zero interest rate policy, around the world, and then off we go the other way. Eventually, right? Maybe, hopefully. Maybe it's 10 years from now. It doesn't matter. But I'll be ready and experienced. And the funny thing is, 10 years from now, I'll be like the oldest man in the room, right? 10 years from now, I'll be mid-50s with like 25 years of trading experience, right? I'll be the smartest man in the room. That'll be good. But because no one will have the experience. Everyone that used to do that will be retired. They'll be 65, 75, right? And I'll be the only one saying, yeah, man, I used to collect 800% interest. Right? And by the way, the pips were worth more than the interest, right? So imagine if you bought these trades, these positions, and you moved your stop to break even, and you just planned on never, ever, ever getting out. At the end of the year, you've collected your 8,000 in interest. It's already in the account, right? But you might be up 1,000 pips per trade, and the 1,000 pips, right, are worth a lot more, right, than your 8,000 in interest. Okay, so you could just be like insane. And of course, here's the other thing: you leverage, you take the $1,000, you get yourself into the 100,000 position. You're collecting $8,000 in interest on that one trade, and it starts going up, and now you're up 100 or 200 pips profit, but you're not even counting that, right? But because we're mark to market, the profit from that trade pips and on interest are being paid to your account in real time. Your available margin goes back to 100% because that trade is now up a couple of hundred pips. So what do? Next dip, you take the money that you have on the first one that you've made on the first one because you're up a couple hundred pips. Let's say it comes back 100 pips, so you're still up 100. Now you can, and then it starts to move back up in the long-term trend. Now you can add a second trade and very quickly jam that stop. Now you have 200,000, but you still only basically leveraged your first $1,000, right? Because you made 1,000 on the pips on the first one, remember? So now you can afford to take the bank's money. That is how I look at it. You take the bank's money, right? The $1,000 you made in pips, you leverage that, put the second trade on, jam that stock, and try to let that run. And now, with your original $1,000, you have 200,000 in position. So now you're collecting 1,600%. And you want to keep doing this like forever, ever. Okay. So, anyways, it's an interesting world. So, John Taylor's firm essentially hedged and did everything else they possibly could so that they were focused only on earning the interest, and they were not interested in earning pips at all. Pretty neat stuff, huh? Yeah, yeah. Oh, yeah. We'll get back to that. So imagine, so one of the things I teach you guys, and I'll have to teach you again in the fall, is how to build a portfolio. FX concepts. So here's another thing. During the recent financial crisis of 2008, 2009, that kind of time, FX concepts blew up. What happened was, I think they were still making money, but everyone else was, like, the stock market was crashing, right? 1,000 points a day kind of stuff, right? And obviously their returns are not going to be as good, but I think they were fine, right? I think they were doing okay. But they were getting hit with redemptions from all their investors that were losing money everywhere else, and everyone was going to cash. And so whether it's their fault or not, the industry dried up and they went out of business after 30 years or something. And that's that. Like a ghost, never happened. Okay, we got a request on the oil. Okay. If you are a bear. So, okay, let's go back to Monday. I said if you were a bull, you would buy it. Is that true? That you were in the zone? That you're going to play off the low? All right, let's try to get this. Okay. Right, there you go. Okay, right? Notice how you're between, I mean, it's close, right? Like, for example, this is your buy zone here. If that's the actual low, pops back up, so maybe you buy it. It's one of these things here, you know you can't sell it here, right? But you can play a double bottom. It's just, yeah, there's some divergence and all that kind of stuff, certainly, yeah. But, you know, whether there's divergence or not, right, Peter, it's like, you know, it just comes down to whether you were a buyer at all. Like I wouldn't do something because I saw divergence. I'd say, well, I want to buy this and I'm looking for reasons to buy it, right? So I'm like, well, someone can sell it. Maybe it'll kick off the double bottom and you hit the double bottom. You're watching this in real time, not on a 4-hour chart, maybe on a 15-minute chart or something, right? And you're like, hey, man, somewhere around here, I think it'll go up. Oh! And all of a sudden, it just like up, higher, higher. You're like, yeah, maybe it's going up. All right, like maybe that double bottom's in play. Maybe. I mean, maybe it's a coincidence. I mean, nothing's a coincidence. I hope you're getting that too. As you're getting more experience as a trader and we're looking at markets, like nothing's a coincidence, is it? Just think of it. You're like, yeah, I'm a bull, kind of want it to go up here, but I get it. There's a bit of a spike bottom. Maybe it'll come down. Maybe it'll hit that. Maybe it'll respect it. Holy crap, look at it take off. I think I should buy it. How do you treat a higher high off a double bottom, guys? What has Uncle Wayne taught you over the years and years and years? Yeah, the 1, 2, 3. Yeah. Well, so the double bottom is a 1. The higher high is the 2. The number 3 part is that. And what is the secret word? Just to confirm that's not BS, backfilling nonsense. What have I taught you? Hammock. You got it. You got it, Bubba. So look, I propose that it's not hocus pocus. Okay, so to me it comes down to you were going to buy it or you were not going to buy it, and that's that. Okay? Like this here, what I'm suggesting, this is if you were going to buy it, that's what was going to happen. If you're going to sell it, and I remember drawing it ahead of time, it would go up and then it would drop, right? You notice that it did do that? So it's like these levels of certainty. If you're going to do something, you should be able to identify where the other bulls are. If you're a bull, right? You should be able to identify where the bears are if you're a bear, and know that that's where you want to act as well, since you're not big enough to move the market, and I'm not big enough to move the market. Right? So anyways, if you wanted to go up, a double bottom with the higher high, 1, 2, 3, roll reversal. If you had bought, let's say, the weekly trade plan, if you were to buy it at the M2 and jam your stop below the S, you'd be in it long. If you were a bear on oil going into the new week, you sold it right there, Sunday morning. Actually, it's Monday because oil doesn't open Sunday afternoon. But anyway, so you're there. You could have sold it, right? Lower low, lower high, lower low. At some point, you jam your stop, and what happened? You got it wrong. You were wrong this week. How much money did you lose? Yeah. You noticed it dropped. So let's just say from the central pivot, 48.30. And down here, where is it? 47.30. Okay. About. That's $1,000 profit per contract. It's plausible you saw the 1, 2, 3, or the double bottom coming. It's plausible you saw this spike right off of the area you were worried about, right? And it's possible you took profit with only $500 in your pocket, right? Because you were able to say, all right, I see the support. It's coming up. It's coming up. It's coming up. It's coming up right around 30. And then you notice right at 25, it flips and reverses. You're like, oh my God, boom, 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 right? Maybe maybe you moved your stop from here to here to here, right? You notice that? So if you sold near 30, you still got out at 90, 85, right? $400. And it didn't work out. You're like, dang it. That's a bad week, huh? Only $400 per contract. Oh, son of a. Okay. And if you're a bull, off you go. The nice thing about swing trading is you're wrong when the market changes its mind. You don't get caught on so much volatility, right? When you're right, you make money. When you're wrong, but you know what I mean? There's less volatility and it's more the entire market has to change directions for you to be wrong. Cool. But anyways, so oil's going up. Remember, OPEC's going to try to do something, right, to get oil to go up. There's always going to be someone to drive it up. When the price is right, it'll go up. $47 is just the right price. That's all it is. What's going to happen today that would affect oil prices? Yeah, inventories. Okay. Did you sell it at 49? Good, right? Psych level. Remember, someone's going to want to protect 50, but whatever. You don't have to get caught up on it. Did you miss those days, guys? Go. How easy that is. It's retracing back up to 160. Makes a 50% retracement and drops 3,000 pips. Now, the sad thing, I was hoping that the pound was going to go back up. And we had talked about it a year and a half in advance. And we had calculated GDP and all that kind of stuff. Forward looking on GDP. And then Brexit came along and just killed it even further. Oh, all this junk. Every once in a while, a girl has to clean up her charts, huh? Wow, that's just crazy, huh? What a doozy. Puts it in perspective of where we are now, right? Just doing nothing. Okay. This area here should be the sell zone. Right? So that's pound US dollar. How about pound Aussie dollar? Yeah, that's just a coincidence that it's the weekly R1. Hey, swingers, right? Buy zone, target, sell zone, inside, maybe catchable there. Pretty nice moves. I'm going to move this over to something else. Let's do pissy. It's not pissy. There it is. Too bad I changed it. Looks like there was some pretty good analysis on this one. I'm just going to clear it out. Time for a new day. Tough, huh? Weekly support, weekly resistance, big inside day. Yeah. There's two levels of support I see, obviously. This one and this one. I have to keep an eye on this, see what happens next week. Oh, you can't tell what currency pairs these are? You need a watermark? Yeah, I used to use a watermark, and then one day it just stopped working. So I'll look into that for you. Sure. Wayne at fxbootcamp.com. So is this money suddenly flowing to Switzerland? Are people pulling their money out of London banks and putting it into Swiss banks? Could be a rabbit, could be. If you think that's like a logical, intelligent human response to what's happening right now, that Article 50 has been triggered, then maybe you want to start watching this, or maybe even trading this currency pair. What do you think, guys? John says it'd be expensive to keep it there, but not compared to your bank going out of business, right? Like, what are you going to do? Pull your money out of Barclays and put it into Deutsche Bank? Oh my God. Deutsche Bank is in so much trouble. If you knew what I knew, oh my God. So like, nobody wants to go to Deutsche. So where are you going to put your money? If you were just afraid, let's just say, I mean, we know like the markets just are irrational, right? So you're like, I got to get my money out of London. London's going to go away. It's the end of the world for the UK. Blah 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 blah. All right, great. So you decide to take your money out of London because of you're hysterical. Great, whatever. Plenty of people on this planet are hysterical, especially the rich ones, right? Plenty of hysterical rich people. So they want to get their money out of London. Where do they put it? Yeah, yeah, in Greece, right? Hey, Peter, they're trying to put the money in a Greek ATM. I always think how like the negotiations with Greece just failed for so many years, and then Draghi cut off the money, just cut off the money supply, and over the weekend, from Friday, he cuts off the money supply. Everyone freaks out, runs to the ATMs, withdraws all the money, and all of a sudden there's no cash in the country at all. Monday, sign the paper. Negotiations over. I think, wow, that's reality, huh? That's reality. Talk about a smoking gun, huh? That was, I mean, it was pretty amazing to see that. Just years of negotiation and all this stuff. But one weekend of no money. Negotiations over. We'll sign. Pretty amazing. But, you know, I'm not saying it's good for the Greeks. I'm just saying it happened. Well, the Greeks are turning a surplus now, aren't they? AKA profit. It's amazing what happens when somebody actually starts paying their taxes. Yeah, but you know, I think the unemployment rate in the United States is just dramatically higher than what's reported. And I don't mean it from a point of view like there's conspiracy theory or lying or something. I think there's a huge part of America that either isn't qualified to hold like a regular job or just simply doesn't want one. So when you calculate, you know, the unemployment rate, you start with the workforce. There's got to be 100 million people in the United States that just simply don't work. Don't want to work, are not capable of working. You look at them and you're like, oh my God, you frighten me. Have you ever gone into a coffee shop lately? And you're like, you see like this 18-year-old person making you coffee and you're like, this person's effed. This guy is a mess. This guy is never going to get married. He's never going to have a real job. I don't even like looking at this guy. Right? It's like, wow, this kid is screwed up. I have no idea what's going to happen to this kid over the rest of his life. Right? Yeah, it's got all the Pokemon stuff and still is into it at age 20, right? Yeah, but the whole generation, right, Charles? but yeah, but like really, right? So, and this guy's working. There's a whole group of people just literally, I think, in the world just not working. But in America, you could just do that. You're like, well, you know, someone else is going to buy my dinner for me. We don't need to get into all this kind of philosophical stuff. But anyways, I think in my lifetime and for my children and grandchildren one day, right, the world will be a greatly different place. There's going to be too many people on Earth, and there's not going to be enough money. So like the last 30 or 40 years, the government, especially in the United States, has tried to be everything to everybody, and it's gotten bigger and bigger and bigger. It doesn't matter if you're Republican or Democrat. Every year it gets bigger. And now the federal government's broke, the state government's broke, the local government's broke, and the average American has no money in their banking account. And they have no money saved for retirement, right? So let me just tell you, something's going to change. And there's probably, like I said, 100 million people that just not interested in working. It's not just an American thing. I mean, how about Saudi Arabia? There's a whole country that's not even interested in working. Like if things don't if oil prices don't go up the next couple of years, I mean, places like Saudi Arabia is going to be in serious trouble because there's a whole generation, multiple generations that never actually had to work. You know, there isn't. I don't think. I mean, I've never been to Saudi Arabia, so it shouldn't be tough. But I think there's a whole generation of people that are just like not even really interested. Never had to, never was even a focus. It wasn't a goal of society. Like everybody should work hard and dream and let's all be entrepreneurial. Never had to, right? And there wasn't a need. Why would you? So anyway, all this stuff is change, right? And I honestly think the United States in the next 50 years, before I die, will use India as a model. India is the future, I think. In India, the government gives you nothing. Right? It just makes sure rule of law is somewhat there. But if you get pulled over by the police, don't worry. Just pay them some money. It'll be fine. Don't worry about it. But there's a guy living in your backyard. But you know what? He does the lawn. If your air conditioner breaks, he fixes that too. And his wife is cooking dinner and doing the grocery shopping and practically raising your children for you. But the whole society works. It's an amazing place. Because if you don't work, you don't eat. If you don't eat, you die. And if you die, they throw your body into the ditch. And that's that. And I think the world will get there where, like, think of it. India's got way more than 1 billion people. And it works. It may not work well, but it works. And it's a democracy, which is amazing. So I think that's what will happen, where one day the government will just say, you know what? There are no more entitlements. It's not a political statement. There's just no money. They're like, you're unemployed? We're really sorry, but we don't have any money either. you're crazy or homeless or something, we're really sorry, but there's nothing we can do about that. So you need to find some cardboard and build a little house next to a train track somewhere or under a bridge and just, I don't know, find a way to eat. Good luck, right? I mean, that's where we're going, I think. Yeah, well, and that is the interesting thing, right? So Peter's like, well, that's how it used to be. So if you take that point of view, because remember I studied the history of money and the history of economics and stuff, that's what we used to do. So if you go from that point of view, if you think of World War One to today, right? Let's say 1919, right after World War One, there was a dramatic shift in what the government did. So when veterans came back from that war, people are like, well, we should take care of these guys. We should do something, right? And that was all preceded by economic crisis, which kind of led to World War One. And then, then we had the economic crisis of the 30s, right? And another war. And you take all that together, and suddenly the government grew, and all of a sudden, like, before that point in time, the government didn't track how many people had jobs. It had nothing to do with the government. The government didn't have welfare. The government didn't provide retirement. It wasn't the role of government. It wasn't the purpose of government. Government didn't do that. Government built roads and had an army. Like, you didn't have a job? What the hell did that have to do with the government, right? So if you think of everything before World War One, and you just think of, let's say, the last 100 years, it's been an experiment, right? Think of it that way. It was an experiment, and the experiment grew and grew, and suddenly the government was responsible to make sure people had jobs. The government was responsible to make sure that people had decent working conditions. And then they're like, well, then let's do some other things too. Let's make sure, besides fair employment practices, let's make sure there's no monopolies. Let's make sure there's, right. And it just got bigger and bigger and bigger and bigger and bigger and bigger and bigger. And now it's this ginormous thing, and it's dead broke. But so if it fails, if the giant experiment fails, what will we go to? What will happen? Well, history will repeat itself, right? And I'll be the guy living in Downton Abbey, right? And I'll have staff, gardeners and mechanics and, kitchen staff and waiters. And I was even talking about this with my wife the other day. You wouldn't go out for dinner, right? You wouldn't go out for dinner. If I was doing a business dinner, I would invite my client to the house, and we would dine, right? Yeah, security and stuff. But I would employ 25 to 30 people, right? And that's where we'll probably end up going, right? We'll go back to that, where the government can't provide, society has to provide. And you show up and you're like, I have a capability to do something. I can contribute. I can be a gardener. Can you provide room and shelter for me? I will garden like nobody's business for you. My pansies are better than any pansies you've seen, right? And people will show up. I will work. I am here to work. Do you have work for me? That's usually the number one question. So you go to India, there's a guy, he's got flip-flops, shorts, and that's it. I don't think he even owns a shirt, but he's got a cell phone. Because if you call the cell phone, the incoming calls are free. And you can call him and you say, and he'll do anything for you. So you run into him, you're like, hey man, or let's say you meet him and he's like, do you have work for me? I want to work. You're like, yeah, I got a job for you. Why don't you do this thing? And when it's done, you're like, hey, you did a good job. Here's some money. What's your number? And he gives you the phone number. Now you can call his cell phone whenever you need something done. You can call him. He will show up and he will work, and he needs the money. I think India is really cool that way. Now, India doesn't work very well, right? So your air conditioner breaks down, you call that guy, he shows up relatively quickly, and he and his, I don't know, buddy, look at your air conditioner for 3 days trying to figure out how to fix it. Yeah, maybe they fix it. Yeah, they get it going again somehow, right? But there's work, there's job, and that's that. So yeah, so we're going back to Downton Abbey. That's honestly, I think that's where we're going to go backwards. Then he gets old, yeah, or ill, can't work, and that's a problem too. And you forget these things if you live in a wealthy country, but people in poorer countries, they'll work hard and everything, and all of a sudden they just get like sick, like out of the blue. They're just like boom, like horribly sick. You realize, oh, because they're sleeping on dirt, they're bathing in filthy water, the food is unsanitary. You're like, oh yeah, he's got bubonic plague. He'll be away for a while. You're like, all right, call the other guy. But you're like, life is tough. So whatever, life's tough. I think our social experiment has failed miserably. Look how polarized the United States is politically, right? We have a Republican president, Republican Congress, Republican Senate, and they still can't get anything done. It's amazing because even the parties are so polarized. Even the party can't get something done with a majority. Like, it's amazing. We're all screwed. It's the end of the world. Society is going to collapse. Zombie apocalypse is on us. But you have the opportunity to get filthy, stinking rich before it all goes down. You buy yourself a big fortress and fill it with water and food and guns and bullets. Don't forget the bullets. You need a lot of bullets. And a huge wall, right? And you'll make the Mexicans pay for it. Yeah. Did you see the former finance minister of Mexico being interviewed by CNBC? Did you see this? It was like a week or two ago. And the CNBC woman says to him, hey, well, the United States, whether you like Trump or not, the United States is still a huge trading partner with Mexico, and Mexico relies on the United States. So if Trump says you're going to pay for the wall, you know, you know, why wouldn't you try to negotiate? And he f bombs. Did you see that one? He f bombs it. There's no way that we're going to pay for that wall. And he's like seriously angry. And he's like, we're not going to pay no fucking wall. And he's like, whoa. And she's like, did the former finance minister of Mexico just like F-bomb on live TV? He was that pissed off. Like, wow. Yeah, I think Mexicans are a little bit upset about this. You should try to go, yeah, right on CNBC. Finance minister, not current, former, right? But still, he was livid upset about that. Like, yeah, there you go. So hey, sorry for babbling on. I'm tired. Peace on earth, may the pips be with our profits be above average. Watch the oil, watch the pound. Remember, if the pound weakens, where's the money going to go? Because if it's weakening, that means people are. So think the next step. Where are they going to put their money? It's got to go somewhere. Okay, so I'll see you tomorrow. Awesome, blossom. See you tomorrow. Cheers.